5 years ago, this company barely existed. Today, it commands a valuation of $965 billion. That is a figure roughly equal to the annual economic output of the Netherlands, materialized in less than a decade. For the last several years, the market operated on a single assumption. OpenAI was the untouchable Goliath. They held the first-mover advantage, the media narrative, and most of the venture capital. Then came the revenue audit. A typical firm doubles revenue annually. Anthropic climbed from $1 to $47 billion in 16 months. This secured a $65 billion Series H fundraise, Silicon Valley's largest, backed by Wall Street's conservative institutions. The sheer scale of this investment raises a specific question. How did a younger, quieter research lab command a near-trillion-dollar price tag while avoiding the typical hype cycles of its competitors? The answer suggests that the criteria for AI dominance are shifting. The market is no longer just looking for the fastest model. It is looking for the most predictable one. The divergence began in 2021. A group of core researchers, led by Dario Amodei, resigned from OpenAI to build their own organization. The industry default has always been to move fast and break things, shipping code immediately and patching the flaws later. Amodei's faction argued that with autonomous intelligence, breaking things would eventually become an unacceptable corporate liability. This wasn't a moral objection, it was a business thesis. They were betting that the very thing making their competitors grow fast today would eventually limit their growth in the enterprise market. They called this the safety tax. The idea was that as AI became more powerful, the risks of hallucinations and data leaks would become the primary bottleneck for major corporations. To leave the most well-funded company in the world to intentionally build slower was a high-stakes gamble. It assumed that caution would eventually carry a higher premium than speed. 3 years later, the financial data reveals the payoff of that architecture. Anthropic secured partnerships with Amazon and Google, providing infrastructure for 8 of the top 10 Fortune 500 companies. Major banks and logistics firms cannot risk software exposing trade secrets. For these organizations, trust is a hard requirement. While the public conversation focused on consumer chatbots, Anthropic was focused on a top-down capture of the institutional layer. This boring, behind-the-scenes enterprise work is what generated the $47 billion revenue spike. By treating safety as a technical product rather than a PR initiative, they built a financial moat that is proving difficult for faster competitors to replicate. However, the S-1 filing for their public offering reveals the cost of maintaining that moat. Keeping frontier models running requires a massive physical footprint. Anthropic is currently burning $19 billion a year on compute power alone. They don't project actual profitability until 2028, and they face the constant threat of government export controls that could limit their reach. The nearly $1 trillion valuation isn't a guarantee of success. It is a high-wire act balanced against the rising costs of raw computing power. The roadmap is now public. Following the SEC review and an investor roadshow, the company is scheduled to list on the Nasdaq this October. This IPO will be the first major test of whether the market values the safety-first business model as highly as the private investors do. The S-1 reveals that for the world's largest institutions, the cost of an error-prone AI is often higher than the price of a secure one. When the shares finally become available, we'll see exactly how much the public is willing to pay for that security. Would you buy into the safety premium on day one?